So I'm basically going to review one concepts of finance. Hopefully you've seen most of them, not all of them. And this will give you an idea what to expect on the exam. One of the most basic issues, one of the most basic issues in finance is valuation. You want to, you don't have a mic attached to me.
No. It's okay, just talk loud as you can.
One of the most basic issues is how to value something which has cash flows not just now but into the future. So for example, let's say you want to know whether you should drill for oil, and it's going to cost you $100,000 to start the project. So presently you have to shell out $100,000, and that's, let's say, let's call that year zero. And let's say you figure out that there'll be enough oil in the well for 3 years, and year one you'll get $50,000, year two $40,000, year three $30,000. So the question is this a worthwhile project or not? Now, if you don't know anything about finance, you'd say, well, it's costing me $100,000, I'm going to get back $120,000, so it's worth it. But the fact you have to wait for the money diminishes its value. Time erodes the value of money, and the way we therefore compute the real value of it is through a concept known as net present value. So net present value will depend on your cash flows and the market interest rate. So for example, here, we start off spending $100,000 today. That's worth $100,000. There's no wait for that. But then you're going to get these three cash flows. So let's say, for example, your interest rate is 50. So let's say, for example, the interest rate is 4% a year. So you'd have to divide this by 1.04, 1.04 squared, and 1.04 to the third. In your cash flows, of course, you have to take into consideration all your expenses, all your revenues. Eventually, you'll get a number. And if that number is greater than zero, it means you're making profit, you're making money, and it's worthwhile taking on the project. If it's negative, it might mean you have more dollars, but since you're waiting in the future for those dollars, they're not worth as much as what you're spending today. This approach works whether you're looking at a project, you're thinking about investing in a stock, you consider the present value of all the dividends you might get from that stock, plus the present value of the price you'll eventually sell that share for, and that's the value of the stock today. If you feel that the stock is selling for less than that, you should obviously buy it because it's underpriced. If it's selling for more than that, obviously you feel it's overpriced, you either stay away from it or sell it short. So this concept of time value of money really is probably one of the most, if not the most important concept in finance. It is used in all types of valuation. Now, I assumed here that the interest rate for the 3 years would stay the same. But that doesn't always happen. There's something known as interest rate risk. Which basically means, for example, you buy a bond, it's paying you 4% a year, or promises to pay you 4% a year. But next year, interest rates go up to 6%. So now you're sitting with an inferior instrument. I mean, it's going to pay you the 4%, but you could be making 6%. So you might say, I'll sell it. And you'll find someone to buy it, but he's not going to give you full face value for it. Why would someone pay you, for an inferior product, full value? So the value of your bond or your instrument falls. That's what happens when you commit for longer periods of time. You face this concept known as the interest rate risk. And by the way, that type of risk is true of any type of bond, even of the United States government bond. We're used to looking at United States government bonds and calling them risk-free. What we really mean is that they are default risk-free. The United States government, well, at least until recently, is sort of guaranteed not to default. Who knows what the next crisis will bring, but assuming that they get their act together in Washington, we'll assume that they will always pay their bonds. They do have an advantage over the rest of us. Even if they don't have the money, they can always print it. So when you look at that, the fact that the value of your bond can go down, it means that if you'd sell it, you lose some money. And that means that your yield, meaning your own rate of return, is going to fall. See, every bond, not every bond, but many bonds have, well, they used to be before electronic age, little coupons attached to them that you clipped and sent to the company to get your interest payment. So many people confuse yield with coupon rate. The bond might be paying you 4%, but because you're forced to sell at a loss before the term of the bond is up, before it matures, your actual return, your yield, might be less than 4%, will be less than 4%. So don't confuse yield and coupon. Coupon is the stated interest rate that the company pays for the loan. The yield is your actual return. Clearly, the longer the bond, the longer the term of the bond, the greater the interest rate risk is going to be. When a bond does fall in value below its face value, say it's selling at a discount, interest rates, of course, can go the other way as well. Interest rates can go down, and now you're sitting with a great instrument. Everyone's only paying 2%, and you have this 4% instrument. You're not going to sell it for face value then. You're going to sell it for more. You're going to sell it what's called a premium. So discount means below face value, premium means above face value. If interest rates don't change at all, then it sells for its face value, which we call par, P-A-R. Now, when we talk about yield for an investor, see, bonds are tricky because ultimately what you get depends on many, many variables. In my security analysis class just last week, we just began to study about this, and we listed 9 variables right off the bat that your bond might depend on. One of them is the taxability of the bond. Buy a corporate bond, your income that you get from the interest is regular income, it's taxable, your regular interest tax rate. You buy a United States government bond, you don't pay federal taxes. You buy, if you live here in New York City, buy a New York City MAC bond, you often call it triple tax-free because you don't pay any taxes, not federal, not state, and not city.
Why is it?
Well, Unibond, yeah. So very often you'll see analysts draw what's called a yield curve. They'll say, okay, based on the number of years to maturity, the yield to maturity, sometimes might look like this. In other words, the more years it has, the higher the yield. It's called an upward sloping curve. But more important for our conversation is most analysts will tell you that you shouldn't just draw a simple curve, but rather like a band. So for example, if you have a bond with 5 years left, those, let's say this is a yield to maturity curve for double A bonds. Double A represents a certain level of risk. There still might be a difference between some of the bonds yield. Same 5-year bond, both with a double A rating, same risk, same time to maturity, and yet one might be yielding 4.65% and one might be yielding 4.75%. Now, there could be reasons for that. There are reasons for that. Well, someone's an economics major might say there's an inefficiency here. But there are other reasons. For example, what about the taxability of the bond? Or what about your own tax bracket? You know, if you're a retiree or in the 15% tax bracket, the bond's worth more to you. Government bonds or muni bonds pay lower rates because they know that you don't have to pay any taxes at all, and therefore they can say to you, hey, if you had to pay taxes, you would only end up with X. We could actually give you a little more than that. But yet, when you compare that number to what's nominally being offered with the regular corporate bonds, it's lower. So, based on taxability and other factors, 5-year bonds may have a range of rates of yield to maturity, rates of return. So, you see from here then, when interest rates change, your present value will change. And in general, there's an inverse relationship between interest rates and present value. For those of you who are arithmetically astute, you know that when you increase your denominator, the value of your fraction goes down. So if your interest rate goes up, this value will come down. If it goes down, it'll go up. Another issue with interest rates that you should be aware of is how often is the interest computed? Is it computed annually, semi-annually, monthly, daily, continuously? Is it compound interest? Is it simple interest? So the method makes a difference. And if you're compounding, the amount of times it's being compounded makes a difference. Albert Einstein once said that the greatest invention of mankind is compound interest. We knew a thing or two about great inventions. Basically, you could walk into 5 different banks that are all charging 6% a year on a loan, take out a 5-year loan of $50,000, and end up paying back 5 different amounts. This is the method they're using. The more often they compound, the greater it's going to grow. So that means if you deposit money in the bank, you'd like them to compound it continuously. And if you're borrowing money, you'd like them to use simple interest, but it doesn't work out that way. Most often they compound it continuously that way also. Now, one of the trickiest assignments in finance, talking about interest rates, is how do you come up with an appropriate interest rate for any given situation? You know, imagine the following scenario. You graduate Tura, right, after you pass this exam, anything's possible. Get a job, through our career fair, of course. And you're not making more money than you've ever seen in your life. And if you want to celebrate by buying a new car. So you walk in and to the dealership and you negotiate a price, and then the guy says, by the way, how are you paying for this? And that's like one of the minor details you forgot about. So you quickly think on your feet, I'll finance it. Okay, you know. So he sends you to one of the banks that they deal with. And you're waiting online to see the loan officer. Meanwhile, the guy in front of you is negotiating a loan, and you overhear the conversation. He happens to work for Microsoft. They want to build a small office in your community. He's negotiating a construction loan. And you overhear the officer saying to him, okay, Mr. Smith, there'll be no problem. We're going to get this loan out to you. They'll do the construction. It's going to cost you 3.5% a year. Okay, now it's your turn. Sit down. Give the loan officer your best smile. Tell him what you're there for. Tell him you have a job. Show him your income. He says, yeah, we can approve you. You'll be paying 5.5% a year. So you say, what? I just heard you told the guy before me 3.5%. I'm an anti-Semite, so I was Jewish, right? So I'm not getting into whether he is or isn't, but clearly your credit record and Microsoft's credit record, with all due respect to everyone here, is probably a little different. And therefore, your rate of interest you're going to pay is going to be different. In other words, your rate of interest depends to a large part on the amount of risk they associate with you. Same with the company. Business goes in to borrow money. You know, some businesses will get money at a very cheap rate. Businesses that are very strong often on short-term money go to the commercial paper market. They're borrowing money basically the same rates you're getting in your savings account, which is very little. Other times you go in and they charge you a fortune. So the question is, how do you come up with an appropriate interest rate? Tricky question. One of the most famous equations or models or ideas in finance is known as the capital asset pricing model. Or CAPM for short. And basically, what CAPM does, it relates a rate of return to the amount of risk involved. Now, in finance, we have an interesting way of measuring risk. If you look up the word risk in Webster's dictionary, it says the possibility of loss or injury. Loss is also risk in finance, but it's not the end of our risk. We define risk in finance by potential fluctuation. See, a bank account, you open up, let's say, a 1-year CD, is risk-free, because when they tell you they give you 2%, there's no fluctuation. At the end of the year, for every dollar you put in, you have $1.02. But if you put money in the stock market, some stock, you could be all over the place, depending on the fluctuations in the market, and that's the company. So we measure risk by a measure of volatility, and the most common measure of volatility, for those of you who take statistics, you know, is the standard deviation. And we use that as well in finance to measure risk. However, because we're trained in finance to diversify, to try to lower your risk by not putting all your eggs into one basket, we have a slightly simpler measure that we use often, and that measure is known as the beta of the asset. Beta is technically market-related risk, and beta basically comes in 3 categories. And by the way, Greek-letter beta looks something like this. And beta comes in 3 categories: less than 1, equal to 1, and greater than 1. Less than 1 basically means that it's less volatile than the market overall. Equal to 1 means more or less the same volatility as the general market. And greater than 1 means more volatile. So the capital asset pricing model says, okay, how much relative market risk do you have? what does the company have? And the formula or the equation says that the expected return for any investment or company, you can substitute any word you want in there, is going to be equal to the risk-free rate to start. Because whenever you put money into something, the first thing you're investing is time. You want to borrow money from someone else means you want to spend time with somebody else's money what they could have spent the time with. So first we reward you for time, and then we reward you for risk. And the way we do that is we take what's called, I'll write it in shorthand and explain it, the expected return to market over the risk-free rate, multiplied by the beta of that investment. I'll call it beta I investment. So I wrote E of RM. Can you see that?
What was it again? Can you?
E of R, expected return of the market.
Yeah.
In other words, it's like an average return in the marketplace, minus the risk-free rate. That means over and above the risk-free rate. In other words, if we're going to reward you for risk, we're going to reward you for risk based on an amount above the risk-free rate, multiplied by beta, which is a measure for the amount of risk you have. And you plug in numbers, you get values. In equilibrium, this is a fair rate of return for any level of risk, depending on your beta. So, obviously, Microsoft has a lower beta than you do, just by their nature. So that's why he got a lower rate. And in general, when we want to see whether we got a fair rate of return altogether, this is one way we can do it. Put in the risk factors, see what, let's say, Treasury bills pay. That's usually how we measure risk-free rate. And then see what the return should be and see what your return was. You can see if you did well or not. This has uses in corporate finance as well. For example, I'm sure that you know this, whether you're married or not. At the end of each month, one of the pieces of mail that is eagerly anticipated is the utility bill. And the utility bill will look something like this. It'll say use X number of kilowatts, and we're charging you Y number of cents per kilowatt hour, and here's your total bill. Now, Con Ed, if you subscribe to Con Ed, let's say, likes to make money. Why don't they charge you $100 per kilowatt hour? Or $1,000? It'd be a good way to conserve energy, right? You just burn candles instead of electric lights, right? They're not allowed to. Why aren't they allowed to?
Regulations?
That's right. They are regulated by the PSC here in New York, Public Service Commission. So now the PSC has an interesting job. They have to be fair to you, the consumer. They have to be fair to Con Ed and their shareholders as well. What's a fair rate? Well, they will use something like this as well. What's a fair rate to the shareholders of Con Ed, particularly they are taking risks? And based on that fair rate of return, how much would they have to charge to get that rate of return? So this has a lot of uses in finance, but the one we're talking about now is interest rate. It enables us to compute an appropriate interest rate for any type of investment, for any company, for any situation. When you hear, for example, that an investor bought a stock because he thought it was underpriced, what he's saying is that he feels his rate of return is going to be higher than it should be, based on something like this. The nice thing about beta, by the way, well, one of the nice things about beta, there's a lot of nice things, is that when you're dealing with a portfolio of securities, I mentioned before we want to diversify, don't want to put all our eggs in one basket. When you deal with a portfolio of securities and you want to find the beta of the overall portfolio, it's very simple. Just take a weighted average. So for example, if I had $300 invested in security 1 with a beta of 0.9 and $100 invested in security 2 with a beta of 1.9, and I want to know the beta of my portfolio, well, I just wouldn't add 0.9, 1.95 by 2. That doesn't make sense. Not when I have the majority of my portfolio in security 1. I have 75% of my portfolio in security 1, 300 out of 400. So what I would do is I would weight 0.9 times 0.75 and the 1.9 times 0.25, add them together, and that would give me the beta of my portfolio, people portfolio. So beta is very user-friendly in terms of relating it from the makeup, the composition of a portfolio to the overall portfolio. Now we spoke about the concept of risk, and we now know that more risk would imply more return. People are not going to invest in risky assets if they can't get potentially a higher rate of return. What about your own feelings towards risk? Does that count for anything? In finance, we have a term for it. It's known as your level of risk aversion. How well do you tolerate risk? You know, in my men's class, it's an easy one to give an example for. You know, they put spinach on your plate. How well do you tolerate it? Somehow, in the women's division, it doesn't go very big. Now, if you are very risk averse, real nervous Nelly, so what do you think? Are you going to require greater rates of return for each level of risk or lower rates of return? Right? Sure. So your feelings of risk averseness are going to impact on your choice of investment as well. If the market overall exhibits greater levels of risk averseness, overall rates will go up, or rates of return should go up at each level of risk. If you have less, it's less. Well, you'll find it going up, not only in the beta, but in this piece here, which is called the market risk premium. The market risk premium tells us how much extra the market gives at each level of risk, or an average, I should say. So everyone, you know, if the market in general is more risk averse, that's going to go up because they demand it. If it's less risk averse, they'll go down. Beta, as we said, captures all types of risk. So if you think of the sources of risk that you might find in an investment, so, you know, the possibility of non-payment, the possibility of your investments will go bad. in general, if I were comparing, let's say, shoe stores to each other, so every shoe store has more or less the same amount of risk. But sometimes one shoe store inherently will add on risk, more risk than its next door neighbor. For example, let's say it costs $100,000 to open up a shoe business. It's easier this way. Let's say it costs $100,000 to open up a shoe store. So shoe store A, which is on one corner, finances it by himself. Shoe store B doesn't have all $100,000. He only has $80,000. He goes out and borrows the other $20,000. So they both have similar bills to pay: rent, utilities, help, the vendors that they order from. But shoe store B now has an extra bill to pay at the end of the month. It's interest bill. So it will have more risk. So its beta, they might be the same business, but its beta is going to be greater than the first shoe store business. The first shoe store, we would call that unleveraged, no debt. And the second shoe store, we would call a leveraged business, that has debt. So that will also add to the risk. Everything adds into the risk. You have the risk of the business itself, you have the risk of the economy, and other surrounding factors, and you also have the risk of debt if you take that on. Once you take everything into consideration, you get the proper interest rate, figure out your potential cash flows, plug that into your present value formula. Some people would call it a risk-adjusted net present value when you plug everything in. And then you can compute your net present value, see if it's worthwhile or not to undertake the project. Now sometimes you may be faced with an issue where you have two potential projects under consideration. Both might be good. Both might have positive net present values. But there's one problem. The projects are what we call mutually exclusive. Meaning you cannot undertake both of them simultaneously. So for example, it used to be a law before the internet age that if you owned a major newspaper in a city, you were not allowed to also own a major television station in the same city. The idea obviously being we did not want any one person to control the information coming into a particular geographic location. So if you're choosing between buying the New York Times and Channel 7, you couldn't do both. They're mutually exclusive. So then obviously you would go after the one with the higher net present value. They both have, let's say, have positive net present value, but that alone would not be sufficient for you to undertake the project. You would have to go with the higher one because whether for reasons of law, business issues, social issues, whatever the case might be, they're mutually exclusive. You can't adopt them together. Sometimes you have projects that are just economically dependent. In other words, one depends on the other for its profit, or even in the ability to adopt a project. Then, obviously, you have to look at both projects separately and then look at them together as well. Because, for example, let's say you had two parcels of land right next to each other, both facing the Atlantic Ocean. In the real estate industry, we call it beachfront property. And one of them, you build a world-class resort hotel, and on the other one, you decide to build an iron smelting plant. You know, when they mine iron ore out of the mountains, got to purify it, they put in these massive ovens. They're one of the less pleasant places on this planet to be around. So imagine this couple goes on vacation, this world-class hotel, goes on their balcony to smell the evening ocean air, and all of a sudden this black cloud of smoke comes by, they start coughing. So they're not coming back. Not only are they not coming back, they have to tell all their friends not to come as well. So both projects by themselves might be very profitable, but you put them together, they blow up. On the other hand, sometimes one project helps another. I built my resort hotel on one of those properties, and I built a world-class restaurant right next door. Obviously, the more people that come to the hotel, the more diners I'm going to have in my restaurant. Also, economically dependent. So you have to take that into consideration as well. Sometimes two projects are totally independent of each other. You don't have to worry about it. Again, I go back to net present value. If it's positive, go for it. If it's negative, forget about it. I mentioned before about buying a stock that might be underpriced or overpriced. So the question you have to start asking yourself, you know, the people who invest in the market are intelligent people, by and large. And if you think the stock is underpriced, how come no one else thinks so? Or not enough people think so? Because if everyone thought so, the price would be pushed up to its appropriate value. So the question really I'm talking about is what's known as the question of market efficiency. Market efficiency doesn't mean how efficient your stockbroker is, but rather, how does the market adjust to the information that's out there? For those of you who followed the news recently, you might know that one of the proponents of market efficiency, Eugene Fama, just was awarded the Nobel Prize in Economics last week. So the question is are our markets efficient? Do they incorporate all the information into prices? Do they incorporate some information? You know, is incorporating information. For example, there are 10 of you sitting here now. Let's say I said to you right now, close your notebook. The first half of this class is over. I'm going to give you a quiz on what I just said. Would you all get the same grade? No? I guess you guys must have heard a different lecture than you guys. Why not? That's right. Attention spans differ. The ability to process differs. So you all have access to the same information, and yet you're incorporating different amounts of it. The market might work that way as well. There's a lot of information out there. We all live in the computer age today. There's no lack of information out there. So the question is, does the market adjust for that information? So what Fama said, you know, let's divide into 3 levels of efficiency. There's the weak form semi-strong form and the strong form. The weak form of efficiency says the market adjusts for any information included in all past prices and returns. There are people out there that feel that the market moves in trends. So for example, what's today's date? 24th, right? Tomorrow's the 25th then. Let's say you find out that every time Friday's date is a perfect square, the market goes up by 10%. So tomorrow's the 25th, 25 is a perfect square, 5 times 5 is 25, for those of you not familiar with that. So you decide today to call your broker and buy as many shares as you can. Tomorrow, sure enough, market opens, sees the date is the 25th, goes up by 10%. You sell off, you make 10% in one day, comes under the category of good work if you can get it. If you could do that, that would violate weak form of efficiency. Because what are you doing? You're taking past prices and returns, or trends, and using it to make what we call excess profits. 10% on a day is an excess amount of profit. If you did it every day of the year, you make 3,650% profit in your investment. I'm not sure even Warren Buffett can make that claim. There are analysts who feel that the market does go in trends. They're called technical analysts. But most people feel that the market is, in fact, the least weak form. There are some anomalies out there, but overall, no one has found a trend that they can take advantage of, at least not on a consistent basis. So we come to the semi-strong form, which says not only does the market adjust for past prices and returns, but actually adjusts for all publicly available information. So for example, let's say you go home tonight, you get into your car, you turn on the radio, to a real radio station, and you hear that Verizon called a news conference tonight to announce that they've just come out with a new line of cell phones in 25 different colors that are disposable, so that when every woman gets dressed in the morning, they can coordinate their cell phone with their outfit. And you know right here in Flatbush, there's no way any self-respecting woman is going to go out with the phone that doesn't match. And sure enough, tomorrow morning you pass by the Verizon store and they are brimming with merchandise, and there's a line out the door like an Erev Pesach for Shmura Matzah. So you say to yourself, gee, they're going to make a lot of money. Let me buy a couple thousand shares of Verizon tomorrow morning. If in fact you can do that and make lots of money doing it, that would be a violation of the semi-strong form of efficiency, because that form says the market is going to adjust when it opens tomorrow morning at 9:30 or before the after-hours markets. Is the market semi-strong? Perhaps. Not important for this class, but more important you know what semi-strong means. The strong form of efficiency says that the market incorporates all information, even private information, even insider information. Now we have lots of proof that's not true. We have a living proof sitting in the federal penitentiary. His name is Mr. Madoff. During the 1980s, a whole slew of famous insider trading cases. I don't know if you know the names. Ivan Boesky, Michael Milliken. Michael Milliken once paid $550 million in 1 year. The Wall Street Journal did an article on him and found out that year he had the 7th highest GDP in the world. There were 6 countries ahead of him. He made so much money. So, but the strong form says that somehow the market can even adapt for insider information. The point is that the more efficient the market, the less likely you're going to find bargains there. Because if the market's adjusting for information, so the market adjusts and the price adjusts accordingly. Any questions on that? One more aspect on interest rates I want to share with you. You walk into a bank and you and your husband decide you want to buy a home, want a mortgage. You apply for a 30-year loan. Now, 30 years is a long time. Looking around this room, I don't see anyone that can really define 30 years for me yet. Well, no, almost everyone. Professor might still be 29, I'm not sure yet. How in the world can they say, okay, we'll lend you the money, I just, coming here on the radio, that the 30-year mortgage rates, I think they said dropped to 4.13% or something like that. Let's call it 4.25%. How can they lend you money for 30 years when they know that interest rates might change over time? Who knows, in 10 years from now, interest rates might be 20%. We've run a shorter loan in business. Let's say you're a developer. You bought a piece of property, you want to put up an apartment building, know anything about the real estate market here in New York, so you get permission and permits, it can take a couple of years. So you go into a bank and say, I just bought this parcel property, I want to put up an apartment building, I need $5 million of financing. I expect to start building in January of 2016, well, 2 years from now. But I'd like to negotiate a loan now so that when I finally get all the permits and permission in place, I can start building right away. I don't have to start looking for financing then. So now he's asking the bank to arrange a loan for him in the future with an interest rate. Well, how can the bank do that? How can they know what rates are going to be? So this is a very interesting question, and there are several theories regarding that. One theory is known as the pure expectations hypothesis. I'll oversimplify it, then I'll come a little more formal with it. What you could do is go out and ask people what they think interest rates will be in January 2016. After some people stand on Wall Street, maybe send some people to Chicago, outside the financial center there, maybe a few other places in this country. Take a poll. What do you think interest rates will be in January 2016? And take an average of it. Okay, sounds a bit oversimplified, but in essence, what we are looking at is based on perhaps market prices that exist today for various lengths of bonds, what in fact people expect interest rates to be at. You could buy a 5-year bond today, 10-year bond, 12-year bond, whatever. You'll have prices, and from those prices you can extrapolate what people think interest rates are going to be over time. That's called pure expectations hypothesis. There's another theory that says, hold on a second. You want me to lend you money in the future and for a long time. I'm nervous about that. I like to lend money for 1 year at a time. That way I have access to my money, and if interest rates go up, I can lend at that higher rate. That's known as the liquidity preference theory. Which basically says that the longer I borrow money, the greater interest rate I pay. Because investors in general like liquidity. The only way you're going to get them to agree to pay more, to lend out for longer periods of time is if you pay them more. There's another theory out there that says, you know what? All this is irrelevant. Who's the economics major here? You'll appreciate this one. This theory says that there are different markets out there. There's a short-term market. There's an intermediate term, long-term, very long-term market. So for example, some of you are married, some hopefully will be married shortly. So you come off the night of your wedding with X dollars in wedding presents. And the question we often get, what should I do with the money? For most of you, if not all, that money will probably represent the seed money towards buying a home somewhere down the road. Now, when are you going to buy that home? You're not going to wait 35 years to buy the home. Hopefully not. You figure you live in a rented apartment for a while, you start a family, let's say 6, 7 years down the road, you buy a home. So your market is that 6, 7 year market. On the other hand, you have another couple that perhaps had a baby today, and a girl, let's say, and realize that 20 years from now, she's going to get married, she's going to come to Truro, both of which cost a lot of money. I'm not sure which one is more yet, right?
I'll make sure to edit that, okay?
Right. Sounds a little more expensive, so is Truro, right? Don't put that on the tape. Now, so what that couple might do is buy a 20-year zero coupon bond. Let's say they figure between college tuition and a wedding, they'll need $100,000 then. They'll buy a zero coupon bond with a face value of $100,000. They'll pay a fraction of that now because they're foregoing interest until 20 years from now. And 20 years from now, they'll cash it and have $100,000 and do what they have to do. So their horizon is much longer term. They're in a different market segment. So the market segmentation theory says there are different interest rates out there because there are different markets out there. There's a different equilibrium. If there's more demand for cash short-term, those interest rates will be higher. Sometimes you do find short-term rates that are higher. If there's more demand for long-term funds, those rates will be higher. So those are different theories of what interest rates might do. Pure expectation says basically it's just an expectation of what people have in the future. Liquidity means that in general people will charge more money, more interest or higher interest for longer term loans. And market segmentation says it depends on each market. There are separate markets out there for different lengths of loans, and that would determine interest rates. Let's talk a little corporate finance now. Actually, we started with corporate finance in a way also when we talk about valuation of projects. But corporate managers make many decisions. Of course, one is whether they should undertake a project or not. Another decision is whether to give dividends or not, and if they do give dividends, how much? Are dividends good? Are they bad? Does it make a difference? What do you think? If you were a corporate manager, would you give dividends?
No,
You say no. Why not?
we're giving out money of my company that I could use to invest.
Okay, you're giving out money to my company that I could use to reinvest. Okay, first of all, it's not your company, it's the shareholder's company. Second of all, if you do have what to reinvest in, you're right. But if you don't have what to reinvest, what right do you have to hold it off? Imagine you had a grocery store and I managed it for you, and you walked in one day and said, can you hand over the receipts for the past week? I said, no, I'm holding on to it. I probably wouldn't last too long in the job. I mean, the profits belong to shareholders.
Yeah, but they do benefit some way when the stock price goes up, yeah.
Well, okay, well, let's see, do they? Let's give two examples. You buy a share of stock, $10 for the share. So the company has your $10 now, and they invest it. At the end of the year, they made $1 profit, and they send you that dollar. Send you a dividend, $1. So what's your financial position now? You have a $10 share of stock and $1 in cash. Total value, $11. Let's go to scenario number 2. You buy a $10 share of stock, company invests it, they make $1, and they say to you, we need that money, we're going to hold on to it, no dividends. So you don't have $1 in cash, but what's the value of your assets?
Goes up.
It goes up to $11, because the company's not worth $11. So what's the difference? Either way, your assets are $11. So now you're going to say to me, bird in the hand's worth two in the bush. I have $1 of cash in my pocket. So I'll say to you, if it's important to you, you know what you can do? If your stock goes up to $11, sell off $1 worth of stock. And that way, you can have $1 of cash and $10 worth of stock. It's called homemade dividends. Now, if you can do the same thing a manager can, so does dividend policy make a difference? It shouldn't, right? Well, this is not my idea. It's a famous idea brought forth by 2 other Nobel Prize winners. Their names are Miller and Modigliani. Merton Miller and Franco Modigliani. It happens to be that the Jewish one is Modigliani here. And they basically showed that dividend policy is irrelevant. Whether a company gives dividends or doesn't give dividends has no impact on the value of the firm. Sorry?
What did it show?
That the dividend policy of a firm has no impact on the value of the firm. They have other famous theorems as well, that the firm's debt equity ratio has no impact on the value of the firm. Also, the capital structure is irrelevant. Because again, basically, investors can mimic that by themselves. So Miller and Modigliani are famous for their what we call their irrelevance theorems. Dividend policy is irrelevant, capital structure is irrelevant. But there are issues that are relevant for a company. And let's start with, I guess we should start defining different types of business structures that exist out there. The most simple type, of course, is sole proprietorship. what we often call a mom and pop type business. Then have partnership. And in both of those businesses, of course, everybody has unlimited liability. As a matter of fact, in a partnership, every partner is liable for every decision made by every other partner. It's called joint and several liability. And then we have the corporation. Corporation, of course, is not something you can touch, feel, or smell. It's a creation of the law. You could be a one-man corporation. You could be Walmart, be a corporation. The benefit, of course, is there you do have limited liability. You can incorporate partnerships with limited liability by creating a limited partnership where some of the partners are awarded limited liability. So these are different types of business organizations that you might run into. The people who run these businesses, besides trying to figure out cash flows, have other things that they worry about. There are two things that go on in business finance. One is the providing of capital, raising money, either to start or to expand. And the second is to manage the money adequately. You know, there's a saying, a fool and his money are soon parted. So you raise the amount of money you need, you make mistakes using it, that's not good either. So managers have to develop talents for both. They have to know how to raise money and also how to manage it. Now, some businesses require huge amounts of initial capital. For example, let's say you decide you want to compete with Boeing when you graduate. You want to build aircraft. It's obviously not a business you can start in your basement. You need space, you need heavy-duty machinery, and you have to recognize that your conversion cycle, the time you go from making a product and selling it, is long. You know, if Continental Airlines, United Airlines come to you today and order 100 aircraft, it's not like you take them off the shelf and put them in a box and ship them UPS. You got to build them. You probably only deliver a dozen or so a year. Then you got to get paid. So your approach to financing is going to be different there than if you're running a car service. Right? Let's say you decide you're going to open up a car service that drives only women and has only women drivers. Should be a big seller here, right? So what do you need? A desk, a phone system, walkie-talkie maybe, and a ledger to keep track of the trips, and you put an ad in for drivers and cars, and you're ready to roll. You can do it from your living room, perhaps. Different type of investment. Some need heavy-duty initial investment, some don't. Some have constant cash flows, some businesses don't. So those are issues you have to take into account when you make your decisions. Your cash conversion cycle, how you get your receivables, how often you get your receivables, and so on. You have to keep track of your short-term assets and liabilities, your longer-term assets and liabilities. These all go into running a successful business. Any question on that? If you have a business that does business internationally, there are other issues you have to be concerned about. One of the major issues is currency fluctuations. Do business in Japan, how will the dollar match up with the yen? Do business in Europe, how will it match up with the euro? So you might be selling a lot of product, but the dollar loses value, or you import a lot of product and the dollar loses value, it costs you now more dollars to buy that product. All these have impact on your decision making and how you're going to run your business. So as a manager, you have to take all these things into account, starting from providing capital, managing it, taking care of your shareholders, obviously taking care of your workers, while maintaining a decent profit level, or profit margin, so that your shareholders are kept happy. It's interesting that one of the, I won't call it a trick, but one of the moves that sometimes managers make, especially publicly traded companies, is that they'll split their stock split. Now, many people probably don't understand what a stock split is. They hear what a stock split, 2 for 1, they say, oh wow, it's a great company. In reality, a stock split is just an accounting entry. Instead of having one share worth $50, you now have 2 shares worth $25. I don't think any of you would dance for joy if I gave you 4 quarters for $1. Unless you need it for the meter. That's what a stock split is, it's an accounting entry. It does make the stock more affordable. Maybe people can't afford 100 shares at $50, they can afford 100 shares at $25. But it's just an accounting entry. So if I had 1,000 shares till now and the stock split 4 for 1, let's say I now have 4,000 shares, but each one is only worth 1 quarter of its original value. Another aspect that a manager has to look at, or 2 numbers really that they should look at, is what we call the ROE and the ROA. ROE stands for return on equity, and ROA stands for return on assets. For example, let's say we had a company that had $6 of equity, $4 of debt, $10 of assets altogether. So they invested $10, as my example before, and they turn a profit of $1. So, as far as the company is concerned, they earn a 10% return. They invested $10, they made $1 profit, that's the 10% return. But as far as the shareholders are concerned, they did better. They only put in $6 of their own money. So the return on assets was 10%, the return on equity is about 16 2/3%. They made $1 on a $6 investment. So they did better. In general, when you leverage your investment, you will push up your return because you're making money on somebody else's money. By the way, that's why banks take in deposits. When you get a banking charter, technically you don't have to take in any deposits. You can use your own money, lend it out, and make money that way. But just about every bank takes deposits. They welcome your deposits. Why? Hey, you put in your money, they give you a whopping 0.2%, and now you come in for an auto loan, they charge you 5%. 2,500% markup, that's not bad. So, when you make money on someone else's money, you push up your overall rate of return. Because in essence, for every $10 of assets, you only have $6 of equity. This is your assets, this is your equity. this number is known as your equity multiplier. If a firm has no debt, then obviously its return on assets and return on equity is going to be the same. But if it does have debt, it's going to have a higher return on its equity than on its assets, because its equity holders are making money on other people's money. Now I know some of you are thinking, hey, what about the interest I got to pay on that? You know, there's no free lunch here. So let's say, for example, they were paying 5% interest. So they got to pay 20 cents in interest. So they made $1, 20 cents in interest leaves them with 80 cents of profit. If you take 0.80 and divide it by 6, it's 13.3%, still higher than the 10% that the company earned. Or had they put in all $10 of their own, still higher than they would have earned. It actually tells you something even better about debt. Everyone pays taxes, including corporations. Let's say this corporation is in the 30% tax bracket. So how much taxes do they pay? Well, ordinarily they should be paying 30 cents. They made $1 of profit, they should be paying 30 cents in taxes. But the government says, you know what, guys, we have pity on you, you have to borrow and pay interest. We'll allow you to deduct your interest payment from your taxable income, which will leave you with only 80 cents taxable income. And therefore, your tax will only be 24 cents instead of 30. So the government gives them a 6-cent gift. The poor guys that put all $10 of their money into assets have to pay full $1. I'm sorry, full 30 cents of taxes. They'll be left with 70 cents, which is a 7% return. These guys will be left with 56 cents, but a $6 investment is still a 9.33% return. So you want to look at your return on assets versus your return on equity. And you also want to look at any benefits you can get through your debt because of the tax code. Okay, so I've told you a lot of things. Any questions on any of them? So far I've done about 3 years worth of finance courses and amount of time so far. Any questions so far? You didn't realize that finance was so easy? Let me just say a few words about test taking in general. I don't know if I'm overstepping my boundaries, Professor Roth.
You want this taped or this is not taped?
What?
You want this to be not taped or taped?
Let's shut it down.